Hello. On behalf of Fair Value Academy, welcome to the module on market multiples. Just a quick background about Fair Value Academy. In addition to providing new content on valuation for accounting and financial reporting purposes, we are also a fintech company. Thanks to our cutting-edge evaluation platform, we can assist you with all of your fair value needs and provide detailed valuation models and valuation reports for a fraction of the price that you are paying now. And our quality is comparable to top-tier valuation advisory firms. All you need to do is answer a few questions, provide certain financial data, and our platform will generate a defensible fair value. We offer business valuation, goodwill impairment assessment, purchase price allocation, valuation of ESOPs, convertible bonds, preference shares, and intangible assets. We can also assign you an analyst to handle queries from your auditor. Visit www.fairvalueacademy.org to learn more. Now let's jump into today's session, an introduction to market multiples. Looking back at our diagram on business valuation, in this module, we will focus on the market multiples approach to valuation. This is a relative approach, as the value of a business is derived in relation to the pricing of its comparable companies. So what this means? In simple terms, you look at the market, the price of companies which are similar to you, and then you price yourself accordingly. Valuation professionals, investment bankers, and investment analysts prefer the market approach over the DCF approach, as it is easier to do, but more importantly, it makes reference to market prices, which is easier to defend, and unlike the DCF approach, which is very heavy on assumptions. The easiest way to illustrate the market approach is by using the example of someone selling their home. Say you have a 3-bedroom apartment in central London, which you want to sell, and the size of the apartment is 1,000 square foot. The question is, what is your house worth? How much do you sell for? Step 1 is to look at recent market transactions in central London for a property which is similar to your home. And here we identify 3-bedroom apartments with similar characteristics to the house that we want to sell. And these 3-bedroom apartments were recently sold. So these are recent market transactions. If we solely look at selling prices, it doesn't tell us much. As you can see, you have property selling for almost 3 million, 5 million, and 2.5 million. To make this comparable, we look at price per square foot. And this is more meaningful as we can compare, and clearly we can see that the apartment in Trevor Square is the most expensive, whereas there's one in Harrods, which seems to be the cheapest. And we deduce that the price per square foot for a luxury 3-bedroom apartment in central London is around 2,700 per square foot. So let's look back at the 3-bedroom home which you want to sell, which is 1,000 square foot. How do we value this? If your property is 1,000 square foot, and we know that the average market price is around 2,700, then the value of your home should be worth around 2.69 million. I am not here to teach you property valuation, but I think this is a good example to illustrate or to teach the concept of multiples. And I want you to think of the price per square foot as the multiple and the number of square feet as the earnings of a company. And these two metrics give you the equity value of a company. It's called the market approach because these are derived from the market. As I showed you, price per square foot came from market transactions. And P multiples are also derived from market transactions, since we are taking the trading price per share. So when a share trades on the stock exchange, we take the price per share from that transaction on the stock exchange, and we divide it by earnings per share, which we get from the publicly available financial statements. So as you can see, the PE multiple is also referenced from market transactions. When we hear price per square foot is equals to £2,600, this tells us that 1 square foot of luxury property in central London is worth £2,600. However, what does a PE multiple of 10 times mean? It means that if a company's PE multiple is 10 times, this tells us that every dollar of earnings that comes out of this company is worth $10. Now, it may not make sense at first, so let me explain further. In this example, we have Company A and Company B, which are in the construction industry, and both have last 12 months earnings of $1 million. However, Company A is trading at a 10x PE multiple, whereas Company B is trading at a 7x multiple. So the question is, if both companies are in the same industry and have the same earnings, why is one trading at a higher multiple? And usually it's because of two things: risk and growth prospects. Company A is either less risky or it has better growth prospects than Company B, and that's why the market or the PE multiple is higher. So let's investigate further and try to understand why is Company A trading at 10 times earnings, whereas Company B is trading at 7 times. And what I found was that Company A had signed agreements with the government to build roads and bridges for the next 8 years, whereas Company B had projects in the pipeline for only 3 years. So clearly, as an investor, you would be willing to pay more to invest in Company A because it's less risky. It has signed agreements for work for the next 8 years. And when you buy a business, essentially you're buying its future cash flow stream. Company A has a secured cash flow stream for 8 years from its contracted work, whereas Company B has some uncertainty and will need to go and find new projects after 3 years. So to conclude, even though they have the same net earnings, to an investor, $1 of earnings from Company A is worth more than $1 of earnings from Company B. This was a very simplistic example, but we will delve deeper in later sessions. In this session, I will show you the problem of using the PE multiple and why you should avoid it. To illustrate this problem, I will also discuss ROE, return on equity. So the PE multiple is the trading price per share divided by the earnings per share. And if we take the trading price per share and we multiply it by all of the shares outstanding, we will get the market value of equity. And if we take the earnings per share and we multiply it by all of the shares outstanding, we get net income. So another way of calculating the price to earnings multiple is to take the market value of equity divided by net income. And another way of saying market value of equity, and what finance professionals usually refer to this, is market capitalization. Now, I want to show you something interesting. Return on equity. Return on equity is net income divided by the market value of equity. And remember, whenever we calculate multiples and returns, we look at the market value of equity. And the return of equity is usually a percentage. What happens when we inverse the ROE? To do that, we take 1 divided by ROE, and 1 divided by a percentage usually gives us a multiple. And so it inverses, and we get market value divided by net income, which is another way of saying PE multiple. So as you can see, the PE multiple is the inverse of the return on equity formula. But ROE is very problematic. And if ROE is problematic, then the PE multiple becomes problematic. Let me illustrate in this example. In this scenario, we have two identical companies in terms of revenue and operating profits. The only difference between these two companies is its capital structure. This company has 100% equity financing, whereas this company has 50% debt and 50% equity financing. As a result, this company has to pay interest of $300. However, the tax authority allows interest expense to be deductible when you calculate taxable income, so hence there's a $120 tax saving, as you can see here. When we calculate ROE in this example, we see that the second company looks more attractive as it has a higher ROE. But this is solely because of its debt. You're taking net profit divided by equity of 5,000, whereas in this example, you're taking net profit divided by equity, which is much larger. And so ROE for the company with debt looks way more attractive, even though at the operational level, both companies are the same. For this reason, investors, in particular M&A investors, especially private equity investors, prefer to look at ROIC, return on invested capital, when analyzing companies. Let me talk you through ROIC. What is ROIC? Invested capital includes equity, debt, preferred shares, etc. But for this lesson, I will focus on the main sources of capital, which is equity and debt. Equity holders have claims to the earnings after everyone else has been paid. So once you've paid everyone, once you've given everyone their share, what's left in the box is due to equity holders. So the very end of the income statement, which is net income attributable to equity holders, is what's due to shareholders. Debt holders are only due their contractual interest payments. What you agree upfront to pay them in interest and the repayment of capital and nothing more. No upside in profits. If the business does really well, debt holders get no upside. So we can construct the ROIC formula as follows. Net income is due to equity holders, and remember we always use market value of equity when calculating returns and multiples. And interest is due to the debt holder. But remember we said interest is tax deductible, so the true cost of the debt to the company is actually lower. Therefore we put interest after tax. Net income plus interest after tax gives you EBIT after tax, or what we call NOPAT. And the market value of debt and plus the market value of equity gives you the enterprise value. So this is the ROIC formula that you typically see in textbooks. Over here, I've just broken it down to make it easier to visualize. And similar to when we inverse ROE to get the PE multiple, if we inverse ROIC, we get the EV/EBIT multiple, which many of you may have heard about. So let me explain the problem of ROE and then show you how ROIC solves this problem. As illustrated, ROE is distorted by capital structure. However, ROIC shows a return which is not impacted by capital structure. In this case, the ROIC for both companies here is 10%, and it makes sense because they have identical operations. Let's quickly see how they calculated it. Net profit plus interest after tax gives you NOPAT divided by debt plus equity, and it gives you 10%. Net profit plus interest after tax gives you NOPAT divided by debt plus equity gives you 10%. As you can see, ROIC is not impacted by capital structure. As mentioned earlier, the inverse of ROIC is the EV/EBIT multiple, and the inverse of ROE is the PE multiple. The EV/EBIT multiple is what we call an enterprise value multiple, and the PE multiple is what we call an equity value multiple. In the next session, we will delve deeper into enterprise value multiples and equity value multiples. In this session, I will explain the difference between enterprise value multiples and equity value multiples. The assets of a business are mainly financed by debt or equity, and debt investors require their stipulated interest payments and that the loan be repaid. Therefore, debt is always senior to equity, meaning debt holders have the first right to receive any cash flow generated by the business, and the shareholder will get the residual, what's left in the box after paying out everyone else. Let's look at how this flows through to the income statement. Notice operating expenses are paid first, typically to vendors and employees. In any business, employees must be paid first. We ignore depreciation here because it's non-cash. And notice when you add back depreciation, we get what we call EBITDA, earnings before interest, taxes, depreciation, and amortization. Keep this in mind. We will discuss EBITDA in detail later in the session. Next, interest is paid to the debt holders. After that, taxes is paid to the government. And finally, what's left in the box after paying everyone else is net earnings, which go to the shareholders. So as you can see, there is actually some thought behind how the income statement is structured in terms of the order of rights to receive cash flows. Before we move on, I want to highlight one key point. I want to highlight the subtotals before interest, which are EBIT, EBITDA, and sales. And up until this point, we have not paid the debt investors. So up until this point, any cash flow, be it EBITDA, be it EBIT, EBITDA, and sales, are cash flows which are due to both debt and equity holders. Because again, up until this point, we haven't paid the debt investors. And subtotals after interest, so net earnings, are only due to equity holders. When amounts are due to both debt and equity holders, we call this enterprise value. And when amounts are only due to equity holders, we call it equity value. To summarize, when you're working with EBIT, EBITDA, or revenue, since these are before interest expense, they are cash flows that are due to both debt and equity holders. Hence, they form part of the enterprise value multiples, and you can derive from them EV revenue, EV EBITDA, and the EV EBIT multiples. Conversely, when you're working with net income, since it is after interest expense, it's due only to equity holders. Hence, it's an equity value multiple, and you can derive price to earnings and price to book multiples. And the price to book multiple is typically used to value financial services companies like banks and insurers, but we'll talk about that later. Remember, the point I'm trying to make here is that there's no such thing as a price to EBIT or a price to EBITDA or a price to revenue multiple, because there is a mismatch in the numerator and the denominator. And similarly, you will never see such a thing as EV over net income or EV over book value. So just remember to make sure that things are consistent when you are calculating your multiples. So which is better? One thing to note is that enterprise value and equity value multiples serve different purposes and are rarely used together. The most common enterprise value multiple is EV/EBITDA, and the most common equity value multiple is price to earnings. Before we discuss the differences, I want to elaborate on EV/EBITDA multiple. It is the most commonly used multiple in M&A, and for a good reason. Investors are most concerned with cash flow, and EBITDA is a good proxy for cash flow. Because remember, we add back those non-cash items like depreciation and amortization when we derive EBITDA. Let's do a quick example. Say we have two companies that sell toys. Company A manufactures the toys and has lots of plant and machinery, whereas Company B outsources manufacturing. If both companies have the same revenue and the same cost structure, which will have the higher EBIT? Company B, of course, because Company A owns lots of plant and machinery, it will have higher depreciation. And then when you calculate EBIT, you deduct the depreciation, so the EBIT becomes lower. So EBIT of these two companies will look very different solely because one manufactures in-house and the other outsources, yet they have the same revenue and same cost structure. So to make these two companies comparable, we add back the depreciation and amortization. And then when you look at EBITDA, both are similar. So EBITDA sort of normalizes companies which are highly capital intensive. Let's discuss the differences between EV/EBITDA and price to earnings multiples. EV/EBITDA values the overall business. It takes into account all the sources of funding that went into investing into assets in the business. It eliminates capital structure effects, as I showed you the problems with ROE and how ROIC solved it, and ROIC was the inverse of EV/EBIT. It's ideal for comparing companies with different capital structures, non-cash items, and tax rates, as we showed how ROIC solved the problem that ROE caused, and I just explained the example of the two companies, one which had a lot of depreciation and the other which had minimal depreciation. And lastly, EV/EBITDA is the go-to multiple for M&A investors and private equity professionals. The PE multiple values only the equity in the company. It's distorted by capital structure, as we showed the problem of ROE. And remember, the inverse of ROE is the PE multiple. It's difficult to compare companies with different capital structures, non-cash items, and tax rates. And it's typically used in stock picking for personal portfolios and things like that. And PE multiples are rarely used by M&A investors and private equity professionals.